Imagine raw crude oil blasting through a refinery pipeline, one massive, singular input being forced under pressure into a series of smaller, distinct paths. This is a joint manufacturing process. A single unified input is refined and processed right up to the exact moment it fractures into multiple distinct outputs. That threshold is the split-off point. Before it, you have crude oil. After it, asphalt, fuel oil, diesel, kerosene, and gasoline. The $100,000 spent reaching this line is a joint cost. Any money spent refining products after it is a separable cost. Here is the core accounting problem. That initial $100,000 cost is entirely indivisible. We have to mathematically engineer a system to assign a shared, pre-split cost to distinctly individual final products. You might be tempted to just write off that joint cost immediately and move on. Financial reporting standards do not allow that. To determine the accurate inventory cost of these end products for your balance sheet, that shared expense must be systematically allocated. Accountants rely on two conceptual frameworks to execute this: the physical measure-based approach and the market-based approach. The physical approach is an older, outdated method that often falls apart when applied to modern manufacturing complexities. Choosing the wrong allocation metric creates a severe ripple effect. It distorts the stated profitability of every product on your spreadsheet, which can trick management into making disastrous operational decisions. The physical unit method assigns joint costs based on objective physical proportions, usually volume, weight, or linear length. Look at this refinery data table. We processed 1,000 barrels of crude, incurring $100,000 in joint costs. The physical method allocates cost based on the number of barrels. Because asphalt accounts for 300 of the 1,000 barrels, it absorbs exactly 30%, or $30,000, of the joint costs. This exposes what we call the physical fallacy. Physical size does not equal economic value. This calculation blindly treats low-value, bulky items as if they were premium goods. When you assign heavy costs to heavy waste products, they show permanent losses on paper. Meanwhile, your small, highly valuable premium products show artificially inflated profit margins. Because it fails to match assigned costs with a product's actual revenue-generating potential, the physical method is rarely beneficial for financial management. The solution is to use market-based approaches. These methods allocate costs proportionately based on a product's true monetary power in the market. The most straightforward market model is the sales value at split-off method. This calculation determines value using expected sales for the entire production run. The estimated sales value at split-off totals $130,000. Watch asphalt's allocation drop from $30,000 down to just over $13,000 because it represents a much smaller slice of the total monetary pie. But what if a product isn't ready for market at split-off? What if it requires further processing before it can be sold? In that scenario, you use the estimated net realizable value, or NRV method, which bases the allocation on the final expected sales price. There is a mandatory step here. This table shows that before allocating any joint costs, you must subtract all the separable costs required to make the product saleable, deducting these of $138,000. By tethering the allocation denominator to net market reality rather than raw physical output, the estimated NRV method ensures products are costed based on their genuine economic capacity. The final, and most mathematically complex, market-based strategy is the constant gross margin percentage NRV method. Its objective is to allocate joint costs so that the final gross margin percentage is identical for every single product in the run. This chart illustrates step 1, determining the overall gross margin for the entire run. By taking the total final sales value and subtracting both joint and separable costs, we derive a uniform gross margin of 26.21%. Next, as shown in these sequential deductions, we subtract that uniform gross margin from each product's final sales value, and then subtract the separable costs to back into our final allocated joint costs. These three market-based approaches yield a predictable, comparable profitability across the entire product portfolio, making them far superior to physical tracking. Manufacturing also produces anomalies, byproducts. These are outputs generated simultaneously with the main joint products, but they carry a relatively minuscule total market value. The defining managerial question for a byproduct is simple. Do the benefits of processing it further and bringing it to market actually exceed the costs of doing so? If the selling price minus additional processing yields 0 or a negative number, the NRV is negative. The byproduct must be immediately discarded as scrap. If the net realizable value is positive and material, the byproduct is capitalized in a separate inventory account. If it is immaterial, the actual proceeds are just logged as miscellaneous revenue exactly when it is sold. Regardless of when the revenue is recognized, byproducts almost never receive an allocation of the main joint costs. The administrative burden of tracking that data simply outstrips the economic benefit. Retroactive inventory valuation is one thing, but managers also face high-stakes, forward-looking operational choices, like the decision to sell immediately or process further. The strict financial rule is to only process further if the incremental revenue gained exceeds the incremental cost of that extra processing. Here is the cognitive trap that ruins profit margins. Managers often mistakenly factor their neatly allocated joint costs into this forward-looking calculation. The reality is that the joint cost of the product is completely irrelevant at this stage. It is a sunk cost. Look at this standard scenario from a management accounting exam. It highlights a $93,000 upfront refining cost. This number is deployed as a distractor to confuse anyone trying to analyze the incremental profit of processing the food products further. Whether you allocated that sunk cost using NRV, sales value, or a physical metric, the money is already gone. Letting a past allocation dictate a future process destroys your incremental margin. Joint costs present a unique duality in financial management. Utilizing market-based allocation is mandatory for accurate financial reporting and maintaining clear inventory visibility. Yet, rigorous management requires utterly ignoring those exact same allocations once the product hits the split-off point. True financial acumen requires knowing the complex mathematics to allocate a cost and knowing exactly when to ignore it to protect the bottom line.